6 of the most successful money experts in America will join me in talking about mutual funds, options, and commodities. So let's start by finding out whether your feeling should be mutual. Even some people who wouldn't for the life of them part with the fun of picking stocks are willing to leave at least part of that job to a professional by putting some of their money in mutual funds. A mutual fund is a pool of investments managed by a professional. The first mutual fund was formed in 1868 in London. Called the Foreign and Colonial Government Trust, it announced that it would try to provide, and I quote, the investor of moderate means the same advantages as the large capitalists in diminishing the risk of investing in foreign and colonial government stocks by spreading the investment over a number of different stocks, unquote. The idea is still the same today, though mutual funds are bigger than ever and now cover investments of many different kinds. Indeed, some families of mutual funds offer more than 24 choices. They will range from those with very little risk, such as money market funds, right on up through those openly trying for aggressive growth and taking aggressive risks to get there. Some funds are highly specialized, investing only in, say, high-tech stocks, or long-term bonds, or gold stocks. One thing you'll want to know about a fund is whether it is load or no load. A load is just a fancy name for a sales charge. For a small investor, that often runs about 8.5% of the money invested. With a no-load fund, all your money immediately goes to work for you. All funds, though, do hit you with an annual management fee, taking 0.5% or so of the fund's assets as their own compensation. You can easily tell whether a fund you're considering is load or no load by checking its listing in the newspaper. For a no-load fund, the bid and ask prices are identical. For a load fund, the ask price is what you pay to buy the fund. The bid price is what you can sell it for. The difference between the two is the load. The funds you'll consider will probably be open-end. That means there's no limit on the number of shares that may be issued, and the company agrees to buy back your shares for whatever the fund's assets are worth on the day you decide to sell. But there's also such a thing as a closed-end fund, also known as a publicly traded investment company. A closed-end fund is a mutual fund with a limited number of shares. When you buy one, somebody has to sell it, just as with a stock. And like a stock, a closed-end fund is traded each day for whatever the market will bear, which can be less or more than the asset value of the fund's holdings. Before buying any fund, you should check out its goals and its record. Some magazines regularly rate the fund's performances, and you'll especially want to see whether a high flyer in good markets tends to fall to pieces when the averages turn down. You may also want to avail yourself of the privilege of telephone switching. In recent years, this has been made available by several families of funds. To keep your business, even though your strategy may change, the family allows you to move your money from one of its funds to another. For example, back and forth between a stock fund and a money market fund. It's an easy solution for those who, in changing markets, would rather switch than fight. My guests tonight represent two different philosophies on mutual funds. Peter Lynch, who believes that slow but steady wins the race, manages the mutual fund with the best record over the last 10 years, Fidelity Magellan. Dick Fabian, who believes in staying agile, has been publishing the Telephone Switch newsletter since 1976. Peter, we'll begin with you. What would you tell an investor to look for in a mutual fund?
I think the first thing they have to conclude is what level of risk they want to accept. If they have to start and say, if I'm going to put in $5,000, what am I going to do if it goes down 20%? If their answer is, I'll probably think about it's going to go down another 20, and I'm going to cash out, I think they should probably be in a very conservative fund, or better still, be in a money market fund or even the bank.
How would you characterize your own investment philosophy?
I would say what I've done with Magellan is I've tried to look at not predicting the market, not predicting the economy, and try and find companies where either they're a small, profitable company now and they can grow into a medium-sized company or into a large company over several years, or a company that's doing poorly right this minute, and there's some hope, there's some reason why in the next year or two things will get better. Those are the two things that I've tended to buy.
A mutual fund like yours owns a tremendous number of stocks. How many do you own right now?
750 different securities.
How in the world can you follow 750 individual securities?
Well, actually, 100 of those would represent half the fund, and about 200 would represent about 75% of the fund. And actually, I have about 75 savings and loans. And when I buy regional banks, I might buy 50 regional banks to get a big position. So when you talk to one regional bank, you've learned about some of the others. So it's not like 800 different companies. A lot of them are in the same industries. In addition, I have 3 full-time people working with me. I continue to call upon 200 or 300 companies a year myself, and these people are also doing that work.
Dick, let's bring you in. In the 10 years that ended in '84, Peter Lynch's fund was up 1,784%. Why should anyone bother about getting in and out of a fund like that? Why shouldn't they just stay in it?
Well, could we look at one other statistic along with that? In the 10 years ended 1982, okay, it was up 450%. Now, why the big discrepancy? It wasn't because 83 and 84 was so good. It was because in the 10 years ending 84, you did not have a severe bear market.
Well, I'm going to give Peter a chance to respond, but first, tell us what your philosophy would be. How would you handle the investing in mutual funds?
First of all, I know consciously that I am dependent on the portfolio manager of the fund to make money. My function is, after we make money, is not to give it back. I said in a recent issue of the letter in the commentary, if you believed in the next 10 years that we would never have another severe bear market like 73 and 74, then you should buy and hold. But if you believe that there's a probability that 73 and 74 should come again, you've got to do something to protect yourself.
So your belief is that investors in mutual funds, when they have reason to believe that the stock market is going down, should move their money into a money market fund?
Go to cash. Become conservative.
And how can they be smart enough to know when that moment is here?
Let's follow the trend. I'm a trend follower. No prediction.
Tell us how you do it.
Well, I use the 39-week average of the fund. Meaning on that is I maintain a table of the week-ending prices.
So if it's going up, you think it'll keep going up, and if it's going down, you get out?
No, if it's going up, it doesn't mean I think it's still going up. It means it is going up. And the minute it stops going up, then I get out.
Peter, why shouldn't someone go in and out, as we've just heard Dick suggest?
Well, I would support some of Dick's points. The markets have been very favorable in the 8 years I've managed Magellan. I think it's gone up 9-fold, the fund has. But in that period of time, 7 times it's declined 10 to 20%. What I'm afraid it would be is that the public, the likelihood in the next year is the market, sometime the fund's going to decline 10 or 15%, and that they'll get out when it goes down to 10 or 15%, and they won't get back in. I've seen that fund sales tend to be very low when the fund's down, and it tends to be very high after it's risen. So the public would be better off, in my opinion, just riding it out and adding to it every year.
So in your judgment, human nature would have people selling at the wrong time and buying at the wrong time?
My nature, too. I would do the same thing if I had the choice. We run our funds fully invested. I don't have that choice.
You never have any cash on hand?
Never.
What percent is cash right now?
1%.
You're going to use that up tomorrow, probably.
Well, not sure, but...
We've been saying nice things about your record, and it is terrific. But I said earlier that no-load funds had no sales charge. Your fund used to be a no-load fund. Now it charges a 3% load. Why did you go that way? Well,
as you know, when the funds charged, about 1/3 of fund sales last year were no load, 2/3 was load. Most funds are therefore sold with an 8.5%, 9% load. We decided to cut it to about 2 or 3%, do the marketing ourselves, cut out the middleman, and it's very expensive. We have 200 or 300 people on the telephones to explain the funds. We have a high marketing expense. We figure over time that's a very low cost for an individual. If they pay 2, 3% and they stay in for 2, 3, 4, 5 years, that's relatively low cost.
Peter, as you know, many academicians and many unsuccessful investors say that the whole thing is a scam, that it's luck, that it's random selection, that nobody over the course of a lifetime is going to beat the markets. What's your view on that?
Well, I think if you buy just on tips, I think that's true. I think I've seen people that put a lot of money on a stock that was a half-baked idea or quarter-baked, even wasn't even warmed up. I think if you're buying companies that you understand, the individuals can do that themselves. They know what they own, they're patient with it, they keep following the fundamentals, I think they can make substantial money. But if they try and predict the market, try and predict the economy, and try and predict a stock, I think it's just too baffling, and I think it's very hard to do.
Dick, this whole question of temperament comes up in your work as well. Mm-hmm. You once said that you would never manage money for anyone under the age of 45. Why do you say that?
Well, somebody says that's reverse age discrimination. Okay. And my answer to that is until you're 45, you haven't lost enough money yet.
What do you learn when you lose it, except
how
to take pain?
No, you feel at a certain time in your life, and I feel we all go through this learning process, you feel that there's an easy way out there to make a whole lot of money. And you try them. And once you get them out of your system, and after you're 45 years of age, you wake up one morning and you look down the tunnel and you can see the light and you realize you're running out of time, so there's no time for games anymore. Now, the program that I use is terribly dull. So unless it's serious, see, we only traded like 6 times in the last 8 years. So somebody says, well, if I'm really going to make money, you know, and I'm going to be sophisticated, I'm going to trade, how am I going to accomplish that if I only make 6 phone calls in 8 years?
Let's have your comment on the load versus no load question.
Well, first of all, I feel very strongly about Fidelity, okay? And it's not because Peter is here.
Is that uppercase Fidelity?
Yes, okay. The thing is, they have been so outstanding with their performance. I explained, some of my subscribers complain about the fact that I recommend those funds which have loads, low loads.
So you think it's more important to pick the right fund than to worry about whether it's load or no load. Peter, in picking a fund, we're trying to pick a fund with a good record. We're trying to pick a fund with a temperament at the management side akin to our own. But we also get into this whole area of how you pick good stocks, which is your job as well as any investors. What do you look for?
Well, I think the great stocks that I've found, I think if 100 people had visited them or talked to them and kept calling them, I think 99 of them would have bought it. I just think there was something going on. It doesn't happen the first time you visit. Very rarely do you see a company and their order backlogs at record highs, the competitors just got out of business, and the stock's down from 55 to 5. That very rarely happens. Usually there's 5 negatives and 5 positives. And eventually, if you keep calling them, some of the problems go away. So I think then at that moment in time you say to yourself, this company's doing better. And the stock happens to be down. So I think it's the random call and keep working on it that makes the difference.
Now that you've learned all there is to know about mutual funds, let's talk about something a little fancier, options. It may sound mysterious, but there's really nothing complicated about an option. It's just something that gives its purchaser the right to buy or sell a given piece of property at a stated price within a specified time. It's been easy as pie to trade options on stocks since 1973, when options were first listed for trading. Options on more than 500 individual stocks are now traded regularly on 4 different exchanges. The most common option is a call, which is an option to buy 100 shares of a given stock at a set price, known as the striking price, within a set time period. Striking prices are set at 5-point intervals for most stocks. The time periods covered are 3 months apart. Let's take some examples. Let's say you're interested in buying a call on a stock named XYZ, which is trading at $50 a share. You could buy calls expiring in 3 different months, say May, August, and November. The farther away, the more you'd pay. You might choose, say, what's known as a May 50. That's what's known as an at-the-money option. The striking price is the same as today's selling price. A May 50 would give you the right, but not the obligation, to buy 100 shares of XYZ at $50 a share anytime between now and May 17th. Options always expire on the 3rd Friday of a month. The market would set the price each day. Let's say it was 2 1/4 today. Multiply by 100 and you get a price for the call of $225 plus commission. But you might be so sure that XYZ was going up that you would dare to buy an out-of-the-money option, one with a striking price way above today's selling price. You might buy a May 60, giving you the right to buy 100 shares of XYZ at $60 a share. Since you could buy that stock right now in the open market for $10 less, this option clearly isn't worth much now. So let's say today's price is 3/8, or $37.50 plus commission. On the other hand, you might choose an in-the-money option, one with a striking price well below today's selling price, say a May 40. Since this confers an obvious immediate benefit, you can buy the stock for less than it's selling for, it naturally costs more. Let's say today's price is 11 3/4, or $1,175 plus commission. After you've bought your call, 3 things will affect its price: a change in the price of the underlying stock, the time remaining before the option expires, and the mood of the market toward stocks in general. If the stock goes up, the call can skyrocket. If the stock goes down, the most the buyer can lose is the price of his call. The seller of the call may be a speculator, hoping the market will fall, or a very conservative fellow who owns the underlying stock and is willing to have it called away in return for the extra income he gets from selling the call. The reverse of a call is a put. It gives you the right to sell 100 shares of XYZ at a given price during a set period. The buyer of a put may be seeking an insurance policy on a stock he owns. In return for the cost of the put, he's protected against a fall in price. The seller is taking greater risk. He may have to shell out big bucks for a stock whose price has been devastated. Hence the old Wall Street saw, call me ever, put me never. Since 1982, it's also been possible to buy options on stock indexes, in effect a call or a put on the whole market. These have been immensely popular, and in 1984, the volume of trading in stock indexes exceeded the volume of trading in options on individual stocks. Linda Singer is an options specialist who prefers to stay away from many of the newfangled options products and to concentrate instead on the more conservative uses of the contracts. She has been a pioneer in the field of options at the firm of Piper, Jaffray, and Hopwood. Bruce Lipnick, on the other hand, is a money manager who admits to being more aggressive in his use of options. He founded Wharton Asset Management in 1982, but he's been managing other people's money since he was 16, when he convinced his father, a Brooklyn policeman, to let him invest the family's savings in the stock market. Clearly, this is a guy with guts. Linda, many people still believe that options are strictly for investment swingers. Why don't you explain how you use them as a conservative tool?
Well, Lou, we started, when I took over the options department, we made it a basic rule to stick to the basic strategies of option trading, and we stick to the real simple strategies of covered call writing and...
Explain covered call writing. What does that mean?
Covered call writing, the client has to own the underlying stock and then write calls against the stock that they own. Writing
means selling.
Exactly.
Now, if the stock goes up, the person who bought that call is going to take away your stock, isn't he?
That's correct. That's that's what we call an opportunity loss. But that's something that the client should understand before he engages in selling options against his stock position.
Is this a strategy primarily for people interested in more income?
We recommend that that's their primary objective from writing calls against their stock positions. Some people think that the writing calls also gives them some protection on the downside, but that's not something we recommend.
Do you recommend buying calls as well?
Yes, we do. We do a lot of we do our homework, and we do a lot of technical and fundamental analysis of stocks and of the indexes, and make recommendations based on our analysis.
What do you have against all these new instruments I mentioned?
Nothing. We're real excited about index options. It's now consists of about 50 to 60% of my business, and it's a very exciting product for, I think, for the public, for the small investor, because it gives him another way to hedge his portfolio or his stock position.
You mean if you own a lot of stocks, you could sell an index option in the same way that if you own one stock, you could sell an option on that stock?
Absolutely.
Bruce, I said that you were more aggressive in your use of options, but in fact, does that mean that you take greater risks?
Not at all, Lou. Basically, by being more aggressive, we trade anything that has an option against it. We're not concerned whether it's IBM, a treasury bond, or gold, soybeans. As long as we can hedge the position and take out most of the risk or all of the risk, we'll use those options.
Well, it's interesting you say take out all of the risk. Is that really possible in investing?
Sometimes you can set up a position where you long a stock, for example, and you have a put.
You own the stock.
You own the stock, and you buy a put, and it's a relatively undervalued put. And because of the dividends you receive, you'll just have an opportunity cost, not a principal loss, if the stock goes down.
Is that the sort of thing the average investor can figure out for himself or herself?
He could. Generally, it's something that's only occurs for a short period of time. The market might be at a whack or a disparity in the market, and you have to be very quick to take advantage of that.
Linda mentioned index options. Do you make much use of them?
That's one of our biggest strategies right now, is using the index options. We like to use the index options over the futures market because there are futures on the indexes as well.
We're going to be talking about futures in a minute, but let's stick to the index option for a minute. Why do you prefer that to to
Well,
futures?
because you can predetermine your risk.
Whereas the most you can lose is all the money you use to buy it.
Right. Plus, you know, a lot of people think the market's going to go up, and they go out and buy a stock, an individual stock, and then they call up their broker and they find out the market's up 20 points and their stock is down an eighth, and they can't understand that. If they think the market's going to go up, they should buy an index option as opposed to buying an option on an individual stock.
What are some of the other strategies you're using now?
Well, we do a lot of spread trading, where we buy one option and sell another option. We also go out and do synthetics, which is...
Why would you buy and sell at the same time?
Well, you're taking advantage, again, of a disparity in the marketplace. Maybe one option is overvalued versus another option being undervalued.
On the same stock?
Same stock, possibly.
Different
Generally
months of expiration, for example?
Yes.
If you were bullish, would you buy an option that was expiring sooner or later?
You always try to go for the most amount of time because most people don't have good timing in the market. And if you pay a little extra for a few more months, it's worth it.
Linda, let's get back to you. How much money should people have before they get interested in options?
We don't allow people to invest in options at Piper Jaffray without at least an income or a net worth of $25,000. And then we also ask that they have some experience in the stock market or do their homework.
So this is really not the first thing you do in investing. First you ought to get into stocks or mutual funds or both, and then get onto this?
Absolutely. I think a basic understanding of the market's real valuable and necessary.
Are most of your clients making or losing money in options?
Most of my clients that speculate in options lose money, and most of my clients my conservative clients make money. So what I'm telling you is that people that buy options, buy puts and calls, most of them lose money, unfortunately. People that sell calls or sell puts make money.
The seller plays the role of the house. The buyer plays the role of the gambler at the other side of the table, in your view.
Absolutely.
Right. The buyer of an option has a chance to make an awful lot of money with a very small outlay. He may also lose all the money unless he's right about the stock and about the timing and about the price. So it's really not the place you want your last buck, is it?
No, I think...
Or else it will be your last buck.
It could possibly be that way. Options are just another tool to use in investments. To give you an analogy, it's like a knife. You know, you can kill someone with a knife, you can put butter on bread, you can operate and save someone's life. So you really have to know what you're looking for and what your objectives are in the market and diversify if possible.
What's your answer to the question of how much a person should have before they get into options?
Well, again, it goes back to what your objectives are. You know, it depends also how old you are. If you're younger, maybe you can speculate a little more because you can make the money back. But if you're older and you're living on retirement money, you can't really speculate because you have the ability to make the money back.
We just heard an authority on mutual funds who said he wouldn't take any clients who are under 45 years old. Do you have any such age discrimination in options?
No. We don't discriminate.
How about you, Linda? Do you find that age makes a difference in the habits here?
Not at all. Some of my clients are very young and very sophisticated and spend a lot of time learning about the products so that they understand what the risks are and they can evaluate those risks.
Is this a market for people who are able to follow the market closely? I mean, if you have an options position, can you really take off for a month?
No, you can't. I mean, unfortunately, it's something that you have to stay with all the time. It's very time intensive. You have to look at the market every day. You can be in and out of your positions. You know, you can day trade. People are in and out in days.
Do you get involved with the kinds of spreads that Bruce referred to?
Very rarely, because it's very difficult for our clients to make money, for the public to make money on spreads because it requires too many transaction costs.
We're in the age of the computer. Do you use computers in working out these strategies, or do you use instinct?
Both. You have to have a little feel for the market, I think, combined with a lot of the computer background or knowledge that you need. We have a lot of very sophisticated pieces of electronic equipment that help us make those investment decisions.
Bruce, who should not go into the options market?
I don't think it's who should not. It's what you want to achieve in the marketplace. Once again, options you can use to leverage your investments, or you can go out and earn extra income by selling calls or puts against it, or you can protect yourself. It all depends what your objectives are.
Thanks very much, Linda Singer and Bruce Lipnick. The fastest growing and in many respects most exciting form of investing today is the commodities or futures market. Scorned for years as the financial world's answer to a gambling casino, the futures market has taken on more than a trace of respectability recently. When even fairly sophisticated investors once were asked about commodities, they would shriek and then hide. But today, nearly 100 contracts are traded actively on commodities ranging from old standbys like soybeans and wheat to newer ones like plywood and the Mexican peso. How do you participate? You buy a futures contract, which gives you the right to take delivery of a set amount of a commodity, those soybeans or plywood, in some specified future month. Usually, you'll have to put up only about 10% or less of the value of the contract. So the leverage is terrific, up and down. If the contract rises or falls just 10%, you'll have a 100% gain or loss. So look out. A key fact you'll want to remember is that most commodities traders lose money. Estimates run as high as 80 or 90% losers. Why then would anyone even think of entering this dangerous game? Well, first, there may be sound economic reasons to hedge in the futures market. Farmers have been doing this for years, for example, by selling grain and livestock contracts that fix a selling price for the farm's production. Now, ordinary investors can hedge their stock market positions by selling contracts on an equivalent amount of stock index futures, which track the overall movement of the stock market. This can protect the investor against an unexpected jolt. Incidentally, with stock index futures, unlike agricultural commodities, you don't have to worry about actually delivering the goods. Dealings in stock index futures are always settled in cash at the overall value of the index. It's much easier to sell or short a stock index future than it is to sell short individual stocks. And commodities rules are similar whether you're buying or selling cattle or British pounds or whatever. Once you get started, the intricate strategies are endless, but the basic principle is the same. You're betting or hedging on the future price of some commodity. Stock index futures have become the most popular newly introduced futures contracts. In 1984, in fact, they were the second most widely traded of all, beaten in volume only by the contract on Treasury bond futures, which many big institutions use as a way of playing the interest rate game. Meanwhile, traditional favorites such as soybeans and corn increasingly take a back seat to the financial newcomers, for whom clearly the futures lie ahead. Robert Schulman is one of the world's leading experts on commodities. As executive economist at Heinhold Commodities, he keeps tabs on all aspects of the rapidly expanding futures market. At 42, Jim Rogers is a retired private investor and proud of it. During his 12 years in Wall Street, he parlayed $2,500 into $14 million by making extensive use of the futures market. Bob, obviously Jim was exactly the kind of person who should go into the futures market.
That's right.
But let's start by saying who should not.
Oh, Lou, the people who should not are the people who don't have the kind of financial backing that Jim had. If you go in with $5,000 or $10,000,
He started with less than that, though.
Jim is one of the rare ones. It can happen, but you were talking about 80 or 90% losers. And so we have to view it statistically, and I'll grant that he was an exception. But when you start with a very small amount of money, the amount of diversification you can do is very limited, which means you had better be right. Second, even if you are right on trend, the vagaries of the market hour to hour or day to day can knock you out simply because you don't have the capital to maintain your position. Third, with a small amount, if you trade too much, commissions can eat you alive. There are so many reasons why the small player is apt to lose. But I do have to say, in this 80 to 90%, there's another breed. And those are the people who are not regular futures investors, but come in, say, in November and buy a couple of orange juice contracts because it might freeze. Well, yeah, some years they're going to do well, but most years they're not.
Okay, if the small player often gets wiped out, statistics incidentally suggest that the big player often gets wiped out too.
Yes.
How much is enough? How much money do you need to get going?
The odds start to break in your favor when you have a minimum of 20, 25,000 is better. When you get above 50 that you can have to use in the futures market, then the odds start turning into your favor. Then you are able to withstand short-term shocks. You are able to diversify across markets and even across traders.
Give us a little detail on that. You say diversify across markets.
Sure. The different futures markets respond to different stimuli. If it rains in Brazil, it's not going to do anything to stock index futures, but it will to soybean futures.
So you should be involved in whichever market is appropriate at any given time. That sounds like a lot of work.
Sure, and that's why you want to work with a very good account executive who has access to all the information you need and can help you make the good decisions.
And how do we find this genius?
There are a few around. In my years in the business, I have met some of them.
How does the average investor, or at least the average with enough funds as you've just described them, set out to find that perfect broker?
The first thing he's got to do is pick the right commodities house. You want to pick a house that is a member, a clearing member of all the exchanges. That tells you they're well funded. You have very little credit risk. After you find your house, then you look for your broker. You want to find a man that is simpatico with you, who thinks the way you do, whom you are comfortable with. You want to find somebody, if possible, who has expertise in markets in which you don't. If you're a corporate treasurer, you'll be comfortable trading T-bills, T-bonds, the stock indexes, but if you'll pardon me, you won't know beans about beans. Pick somebody who does.
Okay. Jim, Bob has described a strategy in which you diversify, in which you go out and look for the right broker. Did you do any of that?
No, I always invested in things that I thought I would be right about and put a whole lot of eggs in a basket. I didn't try to diversify just for diversification's sake, and I never really took advice from brokers. I always sort of did my own work.
Did you make money right from the start?
I know how to lose money as well as anybody in this room, I promise you. I've lost a lot of money, a lot of times.
Well, let's talk about that start, because Bob has just said, and his advice certainly would be shared by many others in the commodities business, that the amount you started with was too small. How did you start out?
Well, I have to confess, a lot of the money I made at first, at least at first, was in stocks. I did stocks long before I did commodities, and then I learned by doing stocks that frequently, if I didn't understand the commodities market, I wasn't going to understand the stock market, so I sort of came to commodities through stocks.
Is that a progression that you would recommend to other people?
Well, actually, with a hindsight, I think that one should not try stocks or commodities unless you understand both, because you really can't buy electrical equipment manufacturers unless you understand copper or steel or something like that. You have to understand the whole picture.
How would you answer the question that I put to Bob? Who should and should not be in this commodities business?
Usually everybody shouldn't. Just about everybody should stay away.
You want a monopoly for yourself, Tim?
No. But it's a fast game, and you can with the leverage that's there. I mean, 5 or 10% margin, you can get wiped out very, very quickly. You can be right. I could be long copper and think that copper's in a bull market, but if I only put up 5 or 10% margin, a little blip could wipe me out.
Do you typically put up the minimum amount of margin?
I try to work my money to the maximum. At least I used to. I'm not quite so adventuresome as I used to be.
You're getting a little conservative in your old age at 42?
Right. Now I'd like to keep some of it, yes.
Bob, let's get back to you and to the strategies that you recommend for people. Obviously, you don't think they should try for a home run every time. How can they set up a sensible strategy?
Well, Lou, home runs were available in the inflationary period in the 70s, and then all you had to do was buy something and ride it. That's gone. I won't say we're in a deflationary period, but certainly we're in disinflation. And now, instead of looking for a home run, what you have to do is look to hit a lot of singles. If, in the old days, back in the 60s, there were traders who knew how to take 30 cents in profit out of what was ultimately a 10-cent move in corn. That kind of trading techniques are needed again, where we have a significant amount of volatility, but not much trend-wise movement. Home runs, they come with strong trends, but most of the time, at least these days, the trends are not there.
Should the typical commodities investor be entirely out of the commodities markets at times?
Yes, from time to time, he should be out of some markets. But the markets don't all move together. There's always some place to be. And with the rise of options on futures, there is now a way to make money even though prices are not moving. which is a reason to be there.
Jim, you as an example of a fellow who's done this with great success yourself, did you leave the markets behind and take off for a few weeks ever?
Oh, no. When I was investing, investing flat out, I never took any time off. I watched it all every day and every night.
Would you have made more money if you hadn't played sometimes?
Not in those days, because there were so many places to play. There was always some place to play. There was a stock market or a bond market or a currency market or a country or some kind of a commodity that I could always play. I always had something.
What are the tests you use in deciding whether a particular commodities investment is a good one?
Whether it's going to go up or down. I mean,
do you use a computer?
No. I only do fundamental analysis, fundamental research.
You try and decide whether there's a fundamental reason for that commodity to increase in price.
Exactly, and I would strongly advise people not to use any other method of trading. I don't know any rich computer traders. Maybe Bob does, but I don't know any.
What's your view on that, Bob?
When I first got involved in commodities markets, I was a pure fundamentalist, as Jim is, and I held no brief for the technicians. But in the years that I was actively involved, I became convinced that these people did in fact have something to offer. And in the research department I ran, oddly enough, when I kept book on my people and scored them, both the fundamentalists and the technicians, both of them right about 70% of the time. And when they agreed, then I felt very confident.
You know, the two of you are saying the same thing in a different way, which is there's an awful lot of fun here, but an awful lot of risk as well. Thank you very much, Bob Shulman and Jim Rogers. And there we do have to stop. I hope you've enjoyed our second annual investment primer and that it has given you some useful information about mutual funds, options, and commodities, perhaps helping you decide whether any or all of them may be right for you. Obviously, in these few minutes, we couldn't tell you everything, but don't worry. Some people spend a lifetime throwing money into these areas without learning nearly as much as these folks have conveyed tonight. And don't be too concerned that they don't always agree. That disagreement, after all, is what makes markets possible in the first place. I hope we've piqued your interest and helped you learn more about areas that might fit profitably into your financial future. If so, you might want to give a special thank you now to your local public television station. And remember, this was just an opening lesson. The postgraduate course is given every Friday night on Wall Street Week with Louis Rukeyser. That's me, and I'm glad you could join us.
Wall Street Week with Louis Rukeyser and Investment Primer 2 has been produced by Maryland Public Television, which is solely responsible for its content.